Question number 1. On the basis of following information, current dividend, discount rate and growth rate, calculate present value of stock of ABC Limited. Is its stock overvalued if the stock price is 35, ROA is 9% and EPS is 2.25? Show detailed calculation. Just a minute. Let's. If Garish comes now, it will be fun. थोड़ा इस साइड सर जाओ. अच्छा आप नहीं सर सकते उस साइड. आराम से. Shift this side. Yeah, why don't you put that spoon back so you'd be comfortable? तो दरवाजा अटकवायला चमचा है खाली. It's full जुगाड़. थोड़ा सा यहाँ साइड लाओ चमचा. Alright, let's start solving the first part of the question. दिया ना discount rate. वही discount वही assume करने का cost of equity. हाँ. See, generally discount rate is a proxy for all type of cost, interest rate, cost of equity, everything. So it's always contextual. So the first part should be simple. Second part is a bit intuitive. Calculate part A quickly. It should not take a lot of time. Hmm? 30. Okay. All of you got 30? Okay, for those of you who do not know the formula, what method we use here is called as Gordon growth model, which says that value of stock at time 0 is calculated by saying dividend of time 1 divided by cost of equity minus G. Dividend of time 1 is calculated as dividend of time 0 into 1 plus G divided by KE minus G. In the question, the current amount of dividend has been given as 2.5. So 2.50 into 1 plus 2%. G is the growth rate, which is 2%, divided by 10.5% minus 2%, which is 8.5%. Is this 2.55 numerator? So which would be 2.55 divided by 8.5%, and I'm assuming that this number is coming out to be 30. Is that correct? Yes. Are we good to move? Okay. Now the second part is its stock overvalued if stock price is 35, ROE is 9%, EPS is 2.2, show detailed calculation. Okay, now this question can be solved in two parts. So say B, and then say first subpart of B, so you can say italic 1, comparison by calculation of book value per share. Comparison by calculation of book value per share. So first write down in a tabular format EPS 2.25. EPS is in the particulars, amount would be 2.25. Below that write down ROE 9%. Then below that book value per share. So in the same column below that you can write down the formula. And what would be the formula for book value per share now? How can we calculate book value per share? बोलो. ROE is equal to book value per share. So EPS divided by ROE. So book value per share in bracket EPS और उसके नीचे लिखो EPS divided by ROE, the formula. EPS divided by ROE. So how much would be the ROE in that case? Sorry, how much would be the book value per share? 25. And then below that write down current market price 35. Current market price 35. And therefore conclusion, stock is overvalued. Current market price ज़्यादा है, so stock महंगा है, so stock is overvalued. आ रहा है समझ में? Then part 2 of this question. Comparison based on earning yields. Comparison based on earning yield approach. Comparison based on earning yield approach. Okay. So then write down EPS 2.25, discount rate 10.5%, उसके नीचे justified market price per share, justified market price per share. So उसके नीचे लिखो EPS divided by earning yield formula. EPS divided by earning yield 10.5%. So 2.25 divided by 10.5%. How much? 21.43. उसके नीचे लिखो मार्केट प्राइस पर शेयर 35. And the conclusion would be stock is overvalued. Are we okay with this? Are you clear with the logic of second one? What approach we've used? See, yesterday, have you studied price earning ratio? Price earning is market price divided by EPS. So if you take inverse of price earning ratio, what you get is earning yield. For example, a price earning ratio of 5. A price earning ratio of 5 means earning yield of 20%. Why? Because let's assume your EPS was 20, market price was 100. Then P ratio would be EPS is 20 rupees, market price is 100. P ratio is 5, which means that compared to earnings, stock is 5 times. If I inverse the ratio, if I say EPS divided by market price, so 12, कितना था EPS हमारा? 20. 20 by 100, earning yield would be 20%, which is inverse of 5. 20% is inverse of 5. So we've used the same logic that a stock should earn 10.5% of whatever is the market price, and what it has earned is 2.25. So we said 2.25 is 10.5% of some X amount. So X into 10.5% is equal to 2.25, and therefore X is equal to 2.25 divided by 10.5%. Are we clear with the intuition? So we used ROE and we found out book value per share, we compared. We use earning yield, we compare that with EPS, we found out market price which is justified, and then again we compared with current market price. Both. Next question. Dividend growth model. Z Limited is foreseeing a growth rate of 12% per annum in the next 2 years. The growth rate is क्या हो रहा है इसको? The growth rate is likely to fall to 10% for the third year and the fourth year. After that, the growth rate is expected to stabilize at 8% per annum. If the last dividend paid was 1.5 per share, the investor's required rate of return is 16%. Find out intrinsic value per share of Z Limited as of date. Will you be able to solve this? It's again a simple dividend discount model which is multi-stage. First, it will grow at 12%, and then it would grow at 10% for 2 years, and then after that it would grow at 8% forever. Wow, that was fast. How did you solve?
लास्ट जो ये रेट है
हम्म
उससे अपना डिविडेंड एज ऑफ डेट वो होगा लास्ट डिविडेंड पेड प्लस लास्ट ग्रोथ रेट जो 8% है
हम्म
वो करके डिवाइडेड बाय के माइनस जी 8%.
No. See, this is linked to a little bit of economics. I'll cut down short on the economics part just to give you an intuitive idea. See, when you're looking at what is the Gordon growth formula? It says that company will grow at the rate of 8%. But of course, in real life, it doesn't happen that way. That it's not that company will always grow at a constant rate. So it depends on what is the life cycle of the company. So typically, most of the companies will start with an embryonic stage, okay, where their growth rate would be really fast. Then that growth rate per annum would relatively lesser, and then after that they would grow at a constant growth rate. So this is typically called as a three-stage model, where let's say for a few years you're growing at 12%, then for a few years you're growing at 15%, and after that let's say you grow at a constant rate of 8%. So typically this stage in business cycle is called as embryonic stage, or this is also called as growth stage. Then this is the growth one, or this is again called as growth stage, and then this is a stage where your industry has become matured and where the growth rate becomes constant. So if you'd see, a lot of industries fall into this segment today. Okay, so for example, most of the FMCG industries or sector would fall here, where the growth rate you would see per annum would be more or less in the constant zone. But if you see a lot of technology companies, especially biotech, they are currently in this segment. Okay, if you look at online business, probably we might put that into this segment or this segment. So which means that if this is the case, you have to factor in that multiple growth rates of dividend. So how do you solve this question is, I'll first solve a simplistic one for you. Let's say current dividend is 100 rupees. For the first 2 years, let's assume growth of 20%. Next 2 years, let's assume growth of 15%, and after that forever, let's assume to be 8%. This is growth rate, and let's assume cost of equity is 20. Value of stock at time 0 is equal to D1 plus D2 plus D3 plus D4. Gordon growth formula can be applied only and only when the dividend is constant, which means only and only when you reach at a G of 8, then only Gordon growth formula can be applied. So this would be first used in year 5. The first constant dividend you would get in year 5. Are you following what I'm saying? So value of stock at time 4 can be calculated by using dividend of time 5 minus KE by G. So I have D4 plus I will also get V4. And this V4 we will calculate. Let me rewrite the formula. V4 is equal to D5 divided by KE minus G. So that's how we got this V4. The first dividend we will discount for 1 year. Next dividend we will discount for 2 years. This cash flow we will discount for 3 years. And this cash flow cumulatively we will discount for 4 years. And this is the value of your stock. So if current dividend is 100, this dividend would be 120. This would be 144. Can you calculate 144 plus 15%? Then plus 15% again. 191.44. So this is my dividend 4. Now I will calculate my dividend 5, which is this 190.44 into 1.08, growing it by 8%. How much? 209.99 divided by 67, and this divided by KE minus G. My KE was 20, constant G was 8, therefore this would be 12%. So this number divided by 12%. How much? 17? Huh? 96. So this is called as a terminal value of the stock. And then what is the value of my company? 120 discounted for 1 year plus 144 discounted for 2 years plus 165 discounted for 3 years, and this entire number discounted for 4 years at the rate of 20%. This is how you solve for these kind of questions. Are you clear? So do you want to solve the question that we have? Okay, so start. Give it a try, then we will solve it together. The trick that you want to remember is the first year in which dividend growth becomes constant, take that dividend and then calculate the value of stock for a year before that. So which means the first constant dividend is in 5th year here. So you would not consider that dividend 5 as a cash flow, but using that D5 you will get value at time 4, and then that would be a cash flow. आया समझ में? नहीं. देखो, कांस्टेंट डिविडेंड कब से हो रहा है? पहले 2 साल आपका डिविडेंड है 12%, उसके बाद अगले 2 साल आपका डिविडेंड है 10%, उसके बाद योर डिविडेंड फॉर एवर इज गोइंग टू ग्रो एट 8%. सो जो फर्स्ट कांस्टेंट ग्रोथ रेट आ रहा है डिविडेंड का, दैट्स कमिंग इन ईयर 5. So whatever is the dividend you get of year 5, that dividend discounted by KE minus G, this will be the value of stock at year 4. So then in year 4 you can use Gordon growth formula, and at year 4 when you add that value as a cash flow, 4th year cash flow, which means you've sold the stock in year 4. So you don't have to consider dividend of year 5 as a cash flow again. So which means we will consider dividend of year 5 as a cash flow only to find out value of stock at year 4. Try once and then we will solve it together. Or should I solve this for you directly?
So last dividend is whether they want to say at year 5, year 4, after the year 4 or first before 12%. Last dividend paid.
लास्ट डिविडेंड मतलब इसके पहले वाला जो डिविडेंड था D0.
पहले वाला मतलब जो ग्रोथ रेट भी दे रहे 12% के पहले वाला क्या?
D0 जो है आपका वो 1.5 है. Let's solve it together. Okay, let's play safe. Save time. So you can make there are two ways of solving this. First, you can write down a formula. You can say value of stock at time 0 is equal to dividend of time 1 divided by k plus e raised to 1 plus dividend of time 2 divided by 1 plus k e raised to 2 time 3 1 plus cost of equity raised to 3 plus dividend of time 4 plus value of time 4 divided by 1 plus ke raised to 4. ठीक है. So you can make a table like this. This is where you plot time 1, time 2, time 3, time 4 and time 4 again. Then you will say amount of dividend, and this is where you will say value of stock, total cash flow, discount factor and discounted cash flow. Dividend, value of stock, total cash flow, discounted factor and discounted cash flow. The dividend at time 0 is given as 1.5. First 2 year growth rate कितना दिया है? 12%. So 1.5 plus 12% into 1.12. 1.68 कितना? First dividend is how much? 1.68. So dividend of time 1 is 1.68. Then time 2 would be 1.68 into 1.12 again. 1.88. Then 1.88 into 1.1. 06. 1. Huh? 2. 2.069. 2.069 into 1.1. 2.28 and 2.28 into 1.08. 30.73. Solve for this. Tell me how much. 2.28 into 1.08 divided by 8%. K minus G. 30.73. 30.73. So total cash flow now. Year 1 1.68, year 2 1.88, year 3 2.069, year 4 would be 2.28 plus 30.73. The last year cash flow, fourth year, would be 2.28 plus 30.73. How much? 33.01. Discount factor here would be 1 divided by 1.16. 0.8620. Then equal to again. 0.7431. Equal to. 0.6406. Equal to 0.5522. and then multiply these and then find out total. That's the value of the stock. Yeah, 92 का कोई सवाल ही नहीं आता. Even if you total, did you say 22? Okay. Are you clear with the logic or do you want to practice more? It's an important concept. Okay, so this is the way in which you can typically present this question. Let's do one more sum which will help you build better clarity on this. You can say example on multi-stage dividend discount model. Example on multi-stage dividend discount model. Last dividend. So at times they will say last dividend, at times they will say current dividend. Irrespective of what they say, it is always D0. If they say last dividend, it's D0. If they say current dividend, it's D0. If they say expected dividend, then it's D1. ठीक है, but last और current बोला है तो it's always D0. So let's say last dividend 10 rupees. Growth rate for 3 years is 20%. Then for next 2 years is 15%, and after that a constant growth rate or a growth rate forever would be 6%. Cost of equity is 18%. Find out value of the stock. So again, now you would find out value of the stock in which year. हम जो V0 निकालते हैं, so we should find that V in which year now? Yes, we will find it out in the 5th year by using dividend of using dividend of 6th year. We will find out value of stock of 5 year. And will dividend of 6th year a cash flow? No. No. 5th year will be a cash flow. Value will be again a 5th year's cash flow. But we will say that since in the 5th year we are selling the stock, we would not receive the dividend of year 6. Correct? So value 5 would be the last cash flow. Solve. I was better off there. It's very hot here. Yes, have you got the answer?
$139.50.
No. One.
139.40. The value of stock 426 पैसे आ गया क्या difference 101.86
फोर्थ डिविडेंड कितना है? 24.2.
22.85
फोर्थ सिक्स डिविडेंड, सॉरी.
fifth हाँ हाँ
सिक्स डिविडेंड कितना है?
22.85 6% हाँ 24.22
सो 24.22 divided by 12%, correct?
101.84
You're right. Yes. आपका सही है.
201.84 है ना
129.52 is the answer.
426 लिया
क्या चीज?
426 value of stock well dashboard बाद में ही लिया 22.85 plus 201.86 हमें दिए
1 2 एक मिनट. 24.2 है लास्ट डिविडेंड.
लास्ट मींस सिक्स्थ
139 है क्या आंसर आपका?
हाँ 139
ठीक है, दिस इज द आंसर. Please ask question if you're not clear with anything. Are we good to move? Have you got the logic? Krishna, Karishma, Neha, Angelica. Which one? This 201? Value of stock? This one? See here. You want to find out value of stock at year 5, for which you are going to use dividend of year 6. So how much would be dividend of year 6? Dividend of year 5 multiplied with 6 rate, which is constant growth rate, 1.06. Is it correct? Divided by what? Divided by cost of equity minus growth. Cost of equity is how much? 18, and growth rate 6. So that means divided by 12%. So dividend of year 5 into 1.06 divided by 12% will give you 201. हाँ तो ठीक है. That's because of decimal. If you don't take all the decimals, when you divide by percentage, it makes some difference. Clear? Will you be able to solve this? Should we move on to next concept now? Okay, it's an important point, so make sure you are comfortable with this. You can also mark this as important. Okay. Now the next model is Walter's model. Now before we start with Walter's model, write down a formula for Walter's model. Okay. Now Walter's model comes with a very huge set of restrictions and assumptions, and it's kind of a theoretical model which does not have a practical implication. So when we do theory on dividend discount, that time I'm planning to cover this more in depth. But what he says is the value of stock is equal to the dividend company is expected to pay, which is assumed to be constant, plus how much company has retained into the business, so E minus D. So whatever has been retained into the business, on that amount of retention, company will earn rate at the rate of R. So let's say that whatever company reinvests, on that it earns 10%, so into 10%. But this is what company will earn every year. So this is a perpetuity divided by K. And then both these amounts is again a perpetuity, so divided by K again. And then this model is called as Walter's model for dividend. Okay. So if it's not making sense as of now, don't worry. Just remember the formula for the timing. When you'll solve first question, K, cost of equity. So D plus E minus D into R divided by K, and the whole number divided by K one more time.
Into R divided by K.
हाँ, वो into R है ना?
These two divided by K.
हाँ. So you can rewrite this formula. You can say D plus E minus D. This is how you would find it in your textbook, into R by K divided by K again. Okay, but writing it in this fashion makes more sense. It tells you what exactly is happening here. Now what is the conclusion of Walter? He says that if your R means how much do you earn on your investment, and K means how much shareholders expect. So think of it this way, that if your R is greater than K, that means you are earning more than what your shareholders would expect you. So with this formula, when will value maximize? When your payout ratio is 0%. So as long as your R is greater than K, you are earning more to your shareholders than what they demand, it makes sense for you to invest the entire money back into the business, and your payout ratio would be 0% to maximize the value of business. But if your R is less than K, then in that case you are earning less for the shareholder, you are a declining firm, therefore your payout ratio should be 100%. And if your R is equal to K, then it does not matter what is your payout ratio. No matter what you do, the value of the firm would be same. Okay, so this is where we will say it's irrelevant. So how you can build intuition on this? If you're earning more than what shareholders are asking you to earn, it makes sense to reinvest that money into business again and again and again. But if you're earning less, then it makes sense to give out that entire money to the shareholders. Okay, so let's go and approach the first question. Following into information relates to XYZ Limited. Earnings of the company are given, number of shares outstanding given, dividend payout ratio is given, equity capitalization rate 12%, return on investment 15%. What is the market value per share as per Walter's model? What is the optimum dividend payout ratio according to Walter's model and the market value of company share at that payout ratio? Okay, so let me solve the first one for you. Do you want to solve? Or should I solve for you? So let me solve this. Say calculation of value of shares as per Walter's model is the heading. Calculation of value of share using Walter's model. Calculation of value of shares using Walter's model. Alright, so first write down earnings is given as 5 lakhs. Number of shares are 1 lakh. And therefore earning per share is 5. Dividend payout ratio 60%, and therefore dividend per share is 3. Rate of return on investment is given as 15%, and equity capitalization rate is given as 12%. Okay, now this is EPS, this is DPS. Just write down this number as R and this number as K. Once you've written this, then say value of stock as per Walter's model V is equal to D0, which is 3 plus 5 minus 3 into 15% divided by 12%, the whole number divided by 12% again. So 3 plus 2 into, this should be 1.25 divided by 12%. So this should be 5.5. Just check my calculations. Divided by 12%. Hmm? 8 numerator. नहीं 45.8. Did you say 45? 4 दिखा नहीं क्या कैलकुलेटर में? क्यों कैलकुलेटर खराब है या नींद आ रही है? 45.83. Now the second part of the question. Say what is the optimum dividend payout ratio? Okay, so give a heading, optimum dividend payout ratio in as per Walter's model. Okay, and then again make a table. You would say scenario and optimal dividend payout ratio. Okay, so the scenario number 1, that R is greater than K, then this should be 0. Second, R is less than K, optimal dividend ratio 100%. And number 3, R is same as KE, optimum dividend payout ratio is irrelevant. Below that, once you've written these three things, then say conclusion. Since XY limited return on investment, since XY limited's return on investment is higher than equity capitalization rate, optimal dividend payout ratio is 0. Below that, value of stock at 0% payout ratio. Value of stock at 0% is not required, at 0 payout ratio. So solve for value of stock now. Now it would be amount of dividend is 0 plus earnings would be 5. Dividend would be 0 multiplied with 15% divided by 12% divided by 12%.
$2.08.
50.08. Got it? And is it higher than the earlier case? Yes, it will always be the case. So as long as your R is greater than KE, at 0% ratio the value would be maximum. Are we good to move? Next question. Question number 4. Again Walter's model. Sean and company earns 6 per share having capitalization of 10% and return on investment of 20%. According to Walter's model, what should be the price per share at 30% dividend payout ratio? Is this the optimum payout ratio as per Walter model? A 4-mark question. Can you solve the first part? Value of stock. Good. Just rewrite the formula, write the extension of the formula, put the numbers, get the answer. एक सौ दो आएगा शायद. कितना है आपका आंसर?
84.
84. 4.2 and 1.8. So 4.2 into 2, 8.4. 8.4 plus 0.8, 9.2, 10.2. 10.2 10.2 divided by 10%. 102 आना चाहिए.
Dividend rate.
It's 102. Yes, is it done? Anyone struggling? How much, Niranjan? आपका गया मनोज? Okay, in case if you haven't got the answer, dividend is 1.8 plus 6 minus 1.8 into 20% divided by 10%. The whole number divided by 10% again. 1.8 plus 4.2 into 2 divided by 10%. 1.8 plus 8.4 divided by 10%. 10.2 divided by 10%. That's 102. Are we good to move? Next question. Question number 5. Following information is supplied to you: total earnings, number of equity shares, dividend paid, price earning ratio. Ascertain if the company is following an optimal policy. Find out what value should be the PE ratio at which dividend policy will have no effect on value of share. Will your decision change if PE ratio is 8 instead of 12.5? How do you solve this? Is one small point. If you catch that, you know how to solve this question. See, what do we need? D. We need E, EPS. Can we find out EPS? Yes. Can we find out dividend per share? Yes. Now we need two more pieces of information, R and KE. R means how much you earn on your investment. So how can we find out? Yes, ROE. ROE. How do we find out ROE? Earnings divided by total equity, which is how much? 10%. Why? Because your total equity is 20 lakhs. 20,000 into 100 and your total earnings are 2 lakh. That means your return on equity is 10%. So R is 10. And how do you find out cost of equity? How much are shareholders expecting? Take inverse of your PE, because PE is earning yield. So 12.5 is PE. 1 by 12.5 should be 8. So 8% is your capitalization rate. And then again, so which means you're earning 10%, required is 8%. That means the optimal payout ratio should be, optimal payout would be 0. You're earning more. समझते हैं? So I'll just help you with the first part. So write down, make a table. Say total earnings 2 lakh. Number of shares 20,000. Number of shares 20,000. Below that, total equity 20 lakhs. So you can write down how we derive 20 lakhs. You can say 20,000 into 100. 20,000 into 100. Therefore, return on equity in bracket R. Return on equity in bracket R, which is 10%. Again, you can write down 2 lakh divided by 20 lakhs. Then EPS. EPS would be 10. So 2 lakh divided by 20,000. Then DPS, dividend per share. It would be कितना आएगा? 1,50,000 divided by 20,000, 7.5. Below that, price earning ratio 12.5. Below that, earning yield in bracket KE, and then again in next bracket, how did we derive this? 1 divided by 12.5, which is equal to 8%. Okay. Then let's find out solution of part A. Okay. Then write down, saying that part A, the current return on equity of the company is 10%, which is higher than cost of equity of 8%. Therefore, optimal dividend payout ratio should be 0. So to answer a specific question asked, below that a sentence, company's current dividend policy is not optimal. Hence, company's current dividend policy is not optimal. Hence, company's current dividend policy is not optimal. Okay. Who will tell me the answer of part B?
We have to keep R and K constant. Return R we have already found now.
See, at which rate a dividend policy will not have effect on value of share. Dividend policy will not have effect when R is equal to K. And how, at what P R will be equal to K? 10. Because if your P is 10, your cost of equity is 10%. Inverse of 10 would be 10%, 0.10. So write down, for a dividend policy to be irrelevant as per Walter's model, return on investment and cost of equity should be same. Current return on investment, so below that table, make a small table. Current return on investment 10%. So therefore current return on investment 10%. Next line in the table. Therefore required cost of equity 10%. Required cost of equity 10%. And below that P ratio when cost of equity is 10%. P ratio when cost of equity is 10%. So 1 divided by 10% is the formula. And then write down the final answer in your table, which is 10. आ रहा है समझ में? Part C. Will your decision change if it's 8? Yes, because at 8 your cost of equity will become 12.5%, and in that case the optimal dividend payout ratio should be 100%. Correct? So write down the solution to part C. At P of 8, at P ratio of 8, cost of equity would be, at P ratio of 8, cost of equity will be 12.5%. Since in this scenario, cost of equity in bracket 12.5% in bracket 12.5% is higher than return on investments in bracket 10%. Optimal dividend payout ratio should be how much? 100%. Are we good? Okay. Now 6 and 7 we will approach later on, and let's go to question number 8. You can mark this, give this question a 3 star. Okay, this is one of those questions that you might want to see a day before the exam. Piyush Lunkar and Associates presently pay a dividend of ₹1 per share and has a share price of 20. If this dividend were expected to grow at 12% per annum forever, what is the firm's required rate of return using a dividend discount model? So the first part should be simple. That how to find out cost of equity using DDM model. What is the formula?
D divided by market shares price.
D1 by P0 plus
Growth rate.
G. Open up your formula sheet. How do you calculate cost of equity? We had built 3 formulas for cost of equity earlier. One was CAPM, then other one was dividend discount model, and the last one was bond yield plus risk premium. Have you done these 3 formulas? Yes, no? We have. I remember we made a flow chart where I made you write down all the 3 formulas. There were 3 ways to find out cost of equity. This is the one. What is the date for this? No. हाँ? 13 तारीख को 13 तारीख को लिखा है. हाँ, correct. The day on which projector wasn't working. नीचे. Oh, that's good. So, in case if you don't know it, we can rewrite them again. Okay. So you can, before this question, you can write down different formulas for cost of equity. So there are three ways in which we can derive cost of equity. Number one is CAPM, number two is dividend discount model, and number three is bond yield plus risk premium. The formula for CAPM is cost of equity is equal to RFR plus MRP into beta. Rashna, can I say beta into MRP? Okay, good. The next one is dividend discount model, which says cost of equity is equal to D1 by P0 plus G, and bond yield plus risk premium YTM plus risk premium. YTM of the bond plus the risk premium. We've anyways dealt with the intuition of CAPM extensively earlier, so I wouldn't touch on this. The intuition here is that when you buy a stock, there are two possible ways from which you will earn return. Number one is by dividend and number two is by capital appreciation. Correct? So आपके पास अगर 100 रुपए का stock है, and if you feel that I will earn a return, I will get a dividend of 20. So I'm earning about 20% from my dividend, plus value of stock will appreciate by 5%. So total return that I expect is 25%. That's the intuition behind this formula. So we are going to use this formula to solve this particular question. So solve part A. Required rate of return using DDM approach can be calculated as follows. Required rate of return using DDM approach can be calculated as follows. So KE is equal to D1 by P0 plus G is equal to D0 into 1 plus G divided by P0 plus G is equal to current dividend is given as 1 into growth rate is given as 12%. So 1 plus 12%. Price has been given as 20 rupees. 20 plus growth of 12. So which would be equal to 1.12 by 20 plus 12. So this is 12% here. 1.12 by 20 is how much? About 5%. So that's 5.6%. So 5.6% plus 12%, which would give us 17.6% is the answer. (5.6) plus 12 is equal to 17.6. I can rewrite that here again in case if it's not visible. Are we good to move? So the first part was really simple. The second part, instead of this situation in part 1, suppose that the dividends are expected to grow at the rate of 20% for 5 years and then 10% per annum thereafter. What is the firm's required return on equity? Tell me, how do you solve this? बोलो. Okay, see, how do you solve this? This is where you'll have to do some reverse calculation. First to understand, then I'll make you write down this. The current dividend is given to you as 1 rupee. They say that it will grow by 20% for 5 years. So next year it would be 1.2, then it would be 1.44. This is D1, this is D2. In the same fashion, we will have D3, D4, D5. In year 6, it becomes constant. So using dividend of year 6, we should get value of time 5. Then all these cash flows we will discount at some cost of equity. And then that some cost of equity should be the the required cost of equity of your, this should be equal to what? This should be equal to 20, which is your current market price. Following this, and then we will have to reverse calculate and find out what should be the cost of equity here. And this reverse calculation will require trial and error, because it's not a closed loop formula. So we'll have to do some trial and error, and what method we are going to use is extrapolation. Okay, so anyways, when we go to capital budgeting, we'll have to learn this method of extrapolation, which will help you simplify the trial and error process. Okay? So let's do it together. So say that value of the stock today is 20 rupees. Value of stock today is 20 rupees. Required rate of return can be calculated by inputting 20 in Gordon growth model, and solving for KE. ठीक है? So you write down in this fashion. 20 is equal to 1 into 20% is 1.2 divided by 1 plus KE plus 1.44 1 plus KE. बोलो अगला नंबर. 1.44 into 1.2. Is it 1.728? Okay. That is 1.728 divided by 1 plus KE plus 1 into 1.2 again.
Sir, raised to
हाँ होगा. This is raised to 1, this is raised to 2, this is raised to 3. आगे 1.987 divided by 1 plus KE raised to 4 plus 1.285 divided by 1 plus KE raised to 5 plus 2.285 plus 10%. 2.285 plus 10%. हाँ. This number 2.07, and the next number would be 2.07 को 1.2 से मल्टीप्लाई करने के 2.488, and then 2.488 into 1.1 now. दिख नहीं रहा है ना आपको? फोर्थ डिविडेंड है 2.07 and fifth dividend is 2.488. Yeah, it's visible from here now. And then what is the sixth dividend? 2.488 into 1.1. Grow it by 10%, the constant growth rate. How much is that now? 2.737 divided by KE minus 10%. Are we okay here? Now we have to find out 2% between which this 20 will lie. Okay, and then we will have to use some extrapolation method. So how do you make that estimation? So looking at this, we have 5 cash flows, and these cash flows on an average are about, let's say, about 10% of the value of this 20. So if you take an average, it should be about 2 rupees, isn't it? All these dividends, 1.44, 1.78, 2.448. So these are about 10%. plus we have a relatively substantial value here, which means that that required rate of return to make that present value has to be slightly higher than 10. Okay, in fact more higher than 10, so it should be somewhere in the range of 15 to 25. Are you following this? So of course it's a broad range, so we want to make that narrow. So what you do is first you assume, so find out value of stock at an assumed rate of 60%, 16%. So say that valuation or value of stock at assumed rate of 16%. So solve this question, input everything at the rate of 16% and solve for it. So 1.2 divided by 1.16 m plus, and then 1.44 divided by 1.16 square, and so on and so forth. Solve for all the cash flows. Okay, so on the exam you need not rewrite the whole formula, since we might have to make guesses 3 or 4 times. If you rewrite formula every time, it will take time, so you can just find out the final value. And hold on a minute, this is a terminal value, this should be again discounted for 5 years. Yes, how much? Do you want me to help you with the keys? 27. 27.25. Now just to cross check calculations, Yes. How much? 59.
Yes. 59.
See, the first dividend would be 1.2, 1.44, 1.73, 2.07, 2.49, and 2.74. Are dividends same?
Yes.
Now terminal value would be 2.74 divided by 6%. So terminal value is 45.6. Is that same?
Yes.
Total cash flow 1.02, 1.44. These are the total cash flows. Discount factor at the rate of 16%. So 1.2 divided by 1 plus D3, which is 16% raised to E4. And 1 minute. This should be a constant. And then the value of the stock, correct, would be 27.26. How many of you getting 27.26?
20.
Alright. Please ask. Are you not getting the answer? Should I write down the discount factor for you? Discount factors. Discount factors would be 1 divided by 1 plus 16% raised to 1. So if you want up to 4 decimals, these are your discount factors. Then discounted cash flows is equal to this number into this number. And then value of the stock is here, 27.26. Let's try to do it together on your calculator. Let's see if it works. Clear your entire memory. 1.2 divided by 1.16 equal to m plus. 1.44 divided by 1.16 equal to m plus. 1.728 divided by 1.16 equal to m plus. 2.074 divided by 1.16 equal to m plus. Then 2.488 divided by 1.16 equal to Neha, you did it how many times? Are you sure? M plus. Then now the last one where you first find out the terminal value. So terminal value would be 2.74 divided by 6% equal to, yeah, no, hold on. So how much is that now? 45.66. Now why am I getting a different terminal value? 2.74 45.66. Okay, so I have 45.62 because I have all the decimals with me. Then 45, this number that you have on your screen, divided by 1.16 equal to m plus. Memory recall 27.28. Alright? Okay. Now, which means at 16% it was a failed attempt, right? Because we want that value to come out to be 20. So is the rate higher than 16 or lesser than 16? Higher than 16. So now again we'll have to make a guess. We want to reduce that 7 rupee. So if I take at 18%, then I think answer should be close. So take 18% and find out how much. It should be 20.215. I have the answer. So take 18% now. 215 ठीक डेसिमल्स. Should we do this together or are you getting the answer? Yes, Rachna. See, first calculate terminal value. Terminal value now in this case would be 2.74 divided by 8%. 74 divided by 8%. कितना आ रहा है? 34. So last cash flow कितना आएगा? 34.21 और जो भी आपका 34 plus 2.488. So आपका last cash flow होगा 36.7. Growth rate is 10% constant. So last cash flow आ गया 36.7. Angelica? See, we can, what we did in the previous question when we solved, we discounted that 5th year cash flow twice, dividend and value separately. This time we'll do it together. 6th year dividend आपका 2.74 है, आपका cost of equity अभी 18 है, growth rate 10, so that means divided by 8. So 2.74 divided by 8%, that is how much? 34. Plus 5th year dividend is 2.488, so plus 2.488. So your 5th year cash flow is 36.7. Once you have all the cash flows, we can discount them together. So let's try to do it together. Memory recall, memory clear. 1.2 divided by 1.18 equal to m plus. 1.44 divided by 1.18 equal to twice m plus. 1.728 divided by 1.18 equal to m plus. 2.074 divided by 1.18 equal to 4 times m plus. 36.7 divided by 1.18 36.7 divided by 1.18 5 times equal to m plus. Memory recall 20.215. Now ideally on the exam, if you get this, so you can say since at 18% valuation is coming out to be 20.215, the required rate of return should be slightly higher than 18, and you can quote 18.1. Okay, so I'm guessing 18.1 would be a very good approximation for this. Okay, so it's less than 18 and 18.1. Are you following what I'm saying? But so ठीक है, we can practice extrapolation later on. So इसके नीचे आंसर लिख दो सीधे, that since at 18% the present value comes out to be 20.215, the required rate of return should be slightly higher than 18%, say 18.1%, and in bracket say using approximation method. Are we good to move? Okay, now let's say, just to understand what is interpolation, in this question we did not use it, but कैसे हम लोग करते थे. अभी आई एम जस्ट राइटिंग दिस वैल्यूज. ठीक है कि 18% पे जो वैल्यू आ रहा है दैट इज 20.215. ओके, if I use it at 19%, okay, so if I put 19% here, the value will come out to be 17.87. Let's say the question demands us to have a value of 19.5 or let's say 19. Okay, just to understand how that IRR could be derived. So let's say that we wanted to find out that rate at which value would be 19. Okay, what logic do you use? You would say from 18 to 19 there's a difference of 1%. For 1% difference, the value of stock decreases by how much? So 20.215 minus 17.87, 2.345. We want the value of stock to decrease by 1.215. From 20 we want it to reach to 19. Then what should be that percent at which this can be achieved? So 1.215 divided by 2.345. That should be 0.518. So which means the IRR is 18.518%. है समझ में? This is the extrapolation method. Are we good to move? Okay, so next question. Question number 9 should be easy. Though it's called residual, it's same as dividend discount. Slightly different formulas to be used. Company's got book value per share of 137.80. Return on equity is 15%. It follows the policy of retaining 60%. Opportunity cost of capital is 18%. What is the price per share today? How can you solve this? Which model can we use? Gordon growth model. What do we need? We need dividend 1. We need growth rate. To find out dividend 1, we need earning 1. How much is the earning as of now? Yes. Whatever is your book value per share into 15% is your EPS. है ना? Book value per share into ROE is your EPS. Once you have EPS, 60% of that EPS is DPS. Then you have ROE, you also have written it. Yes, 40%. Once you have ROE, you also have retention rate. Then you calculate growth. You also have cost of equity, find out value of stock. Simple. Please ask if you're not clear with anything. Yes, any questions, doubt, any formula not clear to you? Please ask. Manoj, Angelica, Vishnu. Are we good to move then? Hmm? Question number 9. Abhishek Limited has a surplus cash of rupees 90 lakhs and wants to distribute 30% of it to the shareholders. It should be question 10. Abhishek Limited has a surplus cash of 90 lakhs and wants to distribute 30% of it to the shareholders. The company decides to buy back shares. The finance manager of the company estimates that his share price after repurchase is likely to be 10% above the buyback if the buyback route is taken. The number of shares outstanding at present are 10 lakhs and current EPS is 3. Determine the price at which shares can be repurchased if the market capitalization of the company should be 200 lakhs after the buyback. बोलो. What was the market price per share? You can solve this orally. थोड़ा सा logic use करो. It's not difficult. See, I'll explain the scenario. You try to imagine with me. Company has got how much money to buy back the shares? Yes, but it wants to distribute only 30%. So that means, nahi, okay, 27. But before that, let's do some background logic to understand buyback better. See, buying back shares is nothing but, in a way, giving out dividend. Okay, it's more or less a similar concept. Because the ultimate effect, ignoring taxes, the effect in the hands of shareholder is same. Because what happens is when you buy back the share, you're taking back shares from them and you're giving them money. In dividend, you just give them money, you don't take back shares. But when you buy back shares, in a way, that market price adjusts in the same fashion. And therefore, the net effect on the wealth of shareholder, typically in the case of buyback and dividend, is same. So when we do theory, you would understand that better. So here, the company wants to distribute about 27 lakhs and it decides to buy back the share. Okay, now let's say that market capitalization was X before the buyback. It would buy back shares worth 27. So after buyback, it should have become X minus 27 lakhs. But then that would appreciate by 10%. So X minus 27 into 1.1 is equal to 200. Can you find out X? X minus 27 into 1.1 is equal to 200. है ना? क्योंकि 10% बनने के बाद it became 200. So 200 divided by 1.1, which would be how much? 208 plus 27. अच्छा आफ्टर सर्विस कितना है? 208. हाँ, और उसमें से उसको डिवाइड करो 10 लाख से. मतलब 10 से डिवाइड करो सिर्फ, कितना है? 20.88. So share price per share was 20.88. Follow the logic? Yes, no? Let's solve it together. The market price before buyback can be calculated as follows. Market price before buyback can be calculated as follows. ठीक है, so यहाँ पे अब लिखो some important data. Say X is the market capitalization before buyback. X is equal to market capitalization before buyback. So here we will say 200 is equal to X minus 27 into 1.1. So X is equal to 200 divided by 1.1 plus 27. How much is this coming out? 208.84. So 20.84 is the market capitalization before buyback. Then say number of shares before buyback, number of shares outstanding before buyback is equal to 10 lakhs. Therefore, price at which buyback can be effected is 208.84 divided by 10, which is 20.88. So market price per share before buyback is 20.88. Market price per share before buyback. Market price per share before buyback is equal to 208.84 divided by 10 lakh is equal to 20.88. So we've solved for the first part. The number of shares that can be bought back. So how many number of shares can we buy back? We are buying it at 20.88, and how much money do you have? 27 lakhs. So 27 lakhs divided by 20.88. 1.39. 29. So we are going to buy back 1.29 lakh shares. And then in bracket make sure you write rounded off. See, market price per share is how much? 20.88. And how much money do you have? 27 lakhs. So how many shares can you buy back? 27 lakhs divided by 20.88. So 1.29 lakh shares. है समझ में? ठीक है. Part C solution. Total profit before buyback is equal to 10 lakhs into 3 is equal to 30 lakhs. Total profit before buyback is equal to 30 lakhs. 10 lakh number of shares into EPS of 3. Then number of shares after buyback. Number of shares after buyback 10 minus 1.29. 10 minus 1.29 कितना होता है? 8.71. Revised EPS after buyback. Revised EPS after buyback 30 divided by 8.71. 30 divided by 8.71. And then last point, increase in EPS. Increase in EPS after buyback is equal to 0.44. 0.44. Increase in EPS after buyback 0.44. Simple question. The only thing is you should be able to imagine part A. Okay, and that's why the trick is. So don't expect that on the exam there would be a similar question. There might be some other twist in the tail. So you should be able to imagine that, let's say if they say that after buyback it was to be depreciated by 10%, then instead of multiplying with 1.1 we would have multiplied with, इस क्वेश्चन में कह रहा है after buyback it appreciated by 10%. Had it been depreciated by 10%, then we would have multiplied with 0.9. 1 minus 10%, we would have multiplied with 0.9. So if they turn around or twist this question, you should be able to answer. So try to build that logical approach to it. Okay, now one small quick point before we wrap up for the day. See this, let's say a company currently, a shareholder is currently got 2 shares and market price per share is 100 rupees. Okay, there are 2 scenarios now. In one scenario, let's say company pays a dividend of rupees 50 per share. Or in second scenario, company buys back 1 share. When company will pay dividend of 50 per share, we know that generally the value of stock will decrease by the amount of dividend. Is that correct? जैसे 100 रुपए का stock है, if dividend is 50, value of stock will decrease by the amount of dividend. So value of stock is now how much? 2 into 50, 100. And how much cash does the shareholder have? 100, because he received 50 per share. So his total wealth is 200, which is same as the earlier case. If there is a share buyback, he is left with only 1 share. 1 share of 100. And how much cash does he have now? 100. Again his total wealth is 200. And that's why if you keep the impact of taxes constant, if you do not assume taxes, then whether you buy back or you pay dividend, the impact on the shareholder's wealth would be same. Follow the logic? पहला वाला शेयर प्राइस क्यों गिरता है? देखो डिविडेंड क्या है? थिंक ऑफ अ कंपनी इशूज अ शेयर्स इनिशियली इन आईपीओ. सो कैसे इशू करता है? यहाँ पे कुछ रिजर्व्स है, यहाँ पे इक्विटी शेयर कैपिटल है. दिस इज इन अ वे बुक वैल्यू पर शेयर ऑफ द कंपनी, isn't it? So it will do some valuation and it will say that okay, we are issuing shares at 100 rupees per share. So every year when company makes profit, let's say in the first year it made 20 rupees per share. So here in a way your reserves increased and that's why the market price was increasing. Think of it this way, that the reason why market price were increasing because company was accumulating profit, and accumulation of profit means accumulation of wealth. But if company said no, we want to pay a dividend of 10, so some of the reserves will decrease, some of the assets will decrease, and therefore a proportionate change will happen here. The stock price will become 110. If you're finding this difficult to imagine, there is one more way of looking at it. Let's say आपके पास you have a piece of land. Let's assume that this is your land, which is currently 2 acres. And this 2 acres is being represented by 2 documents. Okay, so there are 2 documents. Whoever possesses that one document, it will have half of that land, 1 acre. Let's say that currently the value of land is 10 crores. So each piece of paper is worth how much? 5 crores and 5 crores. Are you following what I'm saying? Now company decided, or this landholder decided, that इसमें से कुछ land हम लोग बेच देंगे. Let's say how much? So let's say 1/4 of that land. So ये land कितने का होगा? 50 लाख का. So 50 lakh worth of land is being sold off, and then these people are given 25 lakhs in cash, each one of them. Now what will happen is that remaining land is worth only 1.5, and therefore that piece of paper is worth now only 1.25 crores. Sorry, 0.75 crores or 0.75 crores or 75 lakhs. आया समझ में क्या हो रहा है? So originally one piece of paper was worth 1 crore. Now that you've received cash worth 25 lakhs, your land, that piece of paper is worth become only 75 lakhs. So what is the meaning of dividend? That company has got some value, it liquidates that some value and gives you in the form of cash. So आपके पास अगर 500 रुपए का शेयर है, so it represents 500 rupee worth of value in the company. So if company gives you 100, company is worth only 400 now. And therefore the value of stock will decrease by the amount of dividend. Okay, so in real world it doesn't decrease exactly by the amount of dividend. It's a theoretical concept, but plus or minus 1 or 2 rupee here and there, but it decreases generally by amount of dividend. Clear?